Single stocks, index funds, mutual funds, ETFs, what are they and what do they all mean? Hey, what's up guys, Adam here, and in this video we're going to be comparing different types of stock investments. Now it must be said that I am not a financial advisor. Everything in this video and on this channel is all for educational purposes. For your own individual circumstances, I would advise that you seek a qualified financial advisor. So with that being said, let's get right into the video. So let's start off then with single or individual stocks. Now a stock in its own right is an ownership in one or multiple companies. However though, that doesn't really tell us the value of that ownership within the company. Now that is where shares come in. Now I mentioned shares in my beginner's plan to invest in, so be sure to take a look at that video. Now a share will tell us the exact value of a specific stock. So for example, let's take Apple stock. Let's say the value of a share within Apple stock is £100. If I was to buy £1,000 worth of Apple stock, that would give me 10 shares. And likewise, if I was to buy 20 shares, that would cost me £2,000. Now, similarly to Apple, other large companies will also be found on the stock market and will have a share price associated to that specific stock. Now, I would not recommend that beginner investors actually just build up a portfolio of single or individual stocks. That's mainly down to their volatility and the amount of risk associated with individual stocks. So you're probably thinking, well, Adam, you've mentioned before there's going to be some degree of risk when it comes to investing in the stock market, and that is true. However, the risk is a lot greater when you have a portfolio solely of individual stocks, mainly because 9 times out of 10 as a beginner investor, you're not doing the in-depth research required to have such a small portfolio of individual stocks. So with that in mind, then let's move on to index funds. Now an index fund is essentially a fund that contains a large group of stocks. And the term index in the investing world essentially means tracking. So what it's doing is tracking the performance of a large group of stocks. So think of it like a league table in, say, football, basketball or rugby, where you have 2 teams competing against each other, and the winning team will move up the table and the losing team will move down the table. And essentially that one team will consistently lose game after game until they eventually fall off the league table and they're replaced by another team from a lower league, and that lower league team will move up into the top table. And that is pretty much how it works for an index fund. So essentially the best performing stocks will stay at the top of the fund, where those that are consistently underperforming will move down the fund until they eventually fall out of the fund and are replaced by another stock from a different fund that will move into that particular index fund. So let's take a look at some of the well-known examples of index funds that are available on the market. So starting off with the S&P 500. Now the S&P 500 is a US-based fund that tracks the top performing 500 companies within the US. Likewise, here in the UK, we have the FTSE 100, which tracks the top performing 100 companies within the UK. We also have another example known as the FTSE All World, and that tracks the top performing 3,200 companies around the world and keeps them in that fund. So moving on now to mutual funds. Now mutual funds are fairly similar to index funds in the sense that they are a large group of stocks. However, the difference is the way that they are managed. So mutual funds then are hand-picked stocks that are moved into a fund by a fund manager. And as a result, this usually means that mutual funds are a lot more expensive to invest in because you have now someone, almost a middleman, essentially picking the most ideal stocks for you. So it must be said that whilst fund managers do have a lot of experience understanding the market and knowing what stocks are going to work really well together, at the end of the day they are human. They don't have some sort of crystal ball that's going to perfectly predict how the market is going to perform. I mean, no one could have really understood how 2020 would have taken place, so just bear that in mind when it comes to investing in mutual funds. So the final fund that we're going to be talking about, which is my personal favorite, is the ETF, or the exchange traded fund. Now the ETF is kind of like a balance point between a single or individual stock and an index fund. Now the reason it sits somewhere in between is because, like an index fund, it will track a large group of stocks using the same tracking method of an index fund. However, you can also trade an ETF multiple times throughout the day, whereas with an index fund, you can only trade at the market close. So for example, if you buy into an index fund at say 10 o'clock in the morning and the price is £100, then you can only actually buy at the final closing price. So the final closing price was £105. of that particular fund, then you'd have to actually buy it at that final closing price. Now, another benefit with ETFs is that you're not just limited to company stocks. You can also get ETFs in commodities as well, such as gold, silver, oil and food. You can also get property ETFs, and more recently that's going to be introduced now is you can also get ETFs in the cryptocurrency market as well. So there's a lot more latitude when it comes to ETFs, and a lot of investors actually just build their whole stock portfolio on ETFs. So those are the 4 main types of stock investments that are out there. Now, if you're someone who wants to gear your portfolio more towards growth, that is fine, because you can find certain funds that are more growth centric. Or if you're someone who wants to use the portfolio for dividend income, almost as, a living income, that's fine, because there's definitely more funds out there that are more geared towards issuing dividends as opposed to just purely growth. So guys, that's been the video. There's quite a lot of terminology out there, so hopefully this video will give you some assistance on your investment journey. And if you like the video, you know what to do. Be sure to give it a big like down below. If you want to see more videos like this where we talk about investing, personal finance, business and videography, this is the channel for it. So be sure to hit the subscribe button down below and hit the notification bell so you know when we also upload to this channel. And if you have any questions, you know where to put them in the comment section down below. Anyway guys, this has been Adam here. Thank you for watching. Take care, and of course, I'll see you in the next video. Bye for now.